Understanding letters of credit in international trade. Introduction to letters of credit. In international trade, letters of credit, LC, are one of the key payment methods used to ensure secure transactions between buyers and sellers. They play a critical role in facilitating trade by providing a financial guarantee that the buyer will pay for goods and services upon fulfillment of specific terms. A letter of credit substitutes the buyer's creditworthiness with the credibility of their bank, creating a secure environment for the transaction. Understanding the structure and types of letters of credit is vital for any business engaged in international trade. Footnote: letters of credit provide security by ensuring payment through the involvement of both the buyer's and seller's banks, which helps to facilitate international trade. Definition and purpose of a letter of credit. A letter of credit is a document issued by a bank that guarantees payment to the seller for goods or services, provided that the seller meets specific documentation requirements. The main purpose of an LC is to minimize the risks associated with international trade, such as the risk of non-payment by the buyer. When the seller ships the goods and submits the required documents, such as a bill of lading and commercial invoice, the bank releases the payment to the seller. In essence, it serves as a credit line for international transactions, replacing the buyer's creditworthiness with the bank's guarantee. Footnote: the primary purpose of a letter of credit is to ensure that the seller is paid, contingent upon compliance with all contractual terms and submission of required documents. Types of letters of credit. There are various types of letters of credit, each offering different conditions and terms of payment. The main types include: usance letter of credit allows the buyer time to pay after receiving the goods and the relevant documentation. It provides a specified period, usually 30 to 180 days, for payment after the seller submits the documents. Transferable letter of credit allows the seller to transfer the LC to another beneficiary, often used when the seller is not the actual manufacturer of the goods but acts as an intermediary or representative. Standby letter of credit, often used as collateral for a loan or as a performance guarantee. It is typically a secondary method of payment, activated only if the buyer defaults or fails to meet specific contractual obligations. Documentary letter of credit requires the presentation of specific documents to release payment. This type of letter of credit is performance-driven and ensures that payment is made only if the conditions, such as the shipment of goods, are met. Footnote: different types of letters of credit serve varying purposes in international trade, including guaranteeing payments, ensuring performance, and facilitating the transfer of credit. Documentation in letters of credit. The success of a letter of credit relies heavily on the accuracy and completeness of the required documentation. The most common documents involved in an LC include: pro forma invoice, a preliminary document that outlines the terms of the sale, including the price and description of the goods. It serves as a preliminary quote for the buyer and is used to initiate the letter of credit. Commercial invoice, this document acts as the final bill of sale between the buyer and seller, detailing the price of the goods, delivery terms, and payment conditions. Bill of lading, a receipt from the carrier that acknowledges the shipment of goods. It serves as proof that the seller has shipped the goods and is required to release payment. Packing list, specifies how the goods are packed for shipment, essential for inventory and claim purposes. Draft, a financial instrument similar to a check, where the seller demands payment from the buyer's bank. When the LC is compliant and all documentation is correct, the bank accepts the draft as a negotiable instrument. Footnote: the success of a letter of credit transaction depends on the submission of specific, correct documents, which trigger the bank's obligation to release payment. The structure of a letter of credit. The basic structure of a letter of credit involves multiple parties: the buyer, applicant, the seller, beneficiary, and their respective banks. The process begins when the buyer applies for an LC at their bank, which then issues the LC to the seller. The seller must comply with the terms and conditions specified in the LC, including shipping the goods and submitting the necessary documents. If all conditions are met, the seller's bank receives the documents and forwards them to the buyer's bank for payment. The payment is made only after the buyer's bank verifies that the documentation complies with the LC terms. Footnote: the structure of a letter of credit includes multiple parties, and the transaction progresses with strict adherence to the terms outlined in the LC. Discrepancies and payment risks. Discrepancies in the documentation, such as incorrect shipping dates or missing certificates, can prevent payment under a letter of credit. If the seller's documents do not match the terms specified in the LC, the buyer's bank is not obligated to pay. In such cases, the seller may have to renegotiate the terms with the buyer or correct the discrepancies before receiving payment. This highlights the importance of accuracy and compliance with the LC's terms to avoid delays or non-payment. Footnote: discrepancies in the documentation can result in non-payment, making it essential for the seller to comply with the LC's requirements exactly as specified. Critical dates in letters of credit. Letters of credit are governed by 4 critical dates. Validity date, the date the letter of credit becomes active and the buyer's bank is obligated to make payment. Expiration date, the final date by which the seller must submit the required documents for payment. Shipment date, the date by which the goods must be shipped under the LC. Document submission deadline, the last day the seller can submit documents to the bank for payment. Understanding these dates is crucial for both buyers and sellers to ensure the timely and successful execution of the transaction. Footnote: the critical dates of a letter of credit, validity, expiration, shipment, and document submission, determine the timeline for the transaction and must be strictly adhered to. Conclusion: letters of credit are powerful tools in international trade, offering security to both buyers and sellers. However, they come with complexities and require careful attention to detail, especially in documentation. By understanding the types of letters of credit, their structure, the documentation requirements, and the critical dates, businesses can successfully navigate international trade transactions. Always ensure compliance with the terms of the letter of credit to avoid discrepancies and payment issues. Footnote: understanding letters of credit is essential for businesses involved in international trade, as they ensure secure and efficient transactions when properly executed.